even if the Fed doesn't sort of put a kibosh on where yields are going at the moment?
Well, I mean, the Fed can extend the SLR, which is the liquidity requirement for the banks, so the banks don't have to turn around and sell their treasuries and drive yields up. But that at the margin is a fairly small effect. I think that would be wise. They should do that. But they shouldn't sound that note of like we stand behind repressing the real yield, because we are at the doorstep of a bubble. We could potentially have a bubble if the Fed represses the real yield and the risk-on decline of the equity premium continues. It's a very powerful mathematical formula that drives the market higher. We could easily add 1,000 points in a matter of months to the S&P if the Fed makes that mistake. They should not step on the real yield, the TIPS yield.
Let's talk a bit about where we stand right now in the S&P 500. We hit those record highs, and we sort of reset on those highs. And now we kind of see like you have a market that's a little bit indecisive. They obviously want to see what the Fed is going to do. They're obviously keeping an eye on those real yields here. But there's also keeping an eye on those multiples. And I'm curious as to kind of where you see things shaking out here, given the backdrop of what we know, or at least what we think we know right now.
Right. We look at Shiller's CAPE, except we use operating earnings, or it's substitute going way back. So we look at the operating earnings 10-year average, inflation adjusted of the S&P. And that's about $128 this year. So the market's trading over 31 times that. Now, there has been an uptrend in yields over the last 20, 50, and 100 years. You have to accept that. We know why it happened. But within that uptrend, we are at the doorstep, right at the doorstep of beginning a possible 10 multiple point increase on the CAPE. That's at 1,280 points to the S&P. The only times that ever happened was 1928-29 and 1998-99, and neither one ended well. So the Fed better not drive a bubble, because all bubbles burst. And we see speculative activity all around us. Just look at the digital art and the Bitcoin and the SPACs and the craziness going on in the market today. So the Fed really doesn't need to encourage this.
All right, we're speaking here with Barry Bannister, Chief Equity Strategist over at Stifel. He's sticking with us as we count you down to the close. Less than 5 minutes to go. Taylor, you're at the board.
Big comments from Barry, so let me keep this short and sweet, Romaine. It is Lending Club. Kathy Wood has added this company to her ARK FinTech ETF. This is fueling at one point earlier today the biggest 5-day rally ever for this stock. So this is certainly something that we're watching. And finally, let's flip up the board. And Barry, I'd love to bring you back in here. We're on track for the VIX to close below 20. You go back, it did that once in February. Besides that, it hasn't closed below 20 since March of 2020. What does the VIX below 20 tell you for your equity markets?
One of the things that we do is we overlay the VIX against the global money supply. We use global M2 on your Bloomberg. It's .glmosupp index proxy go. And you do the year-over-year change of the global M2 money, right? And it typically peaks in the last 15 years at 20% year-over-year. It recently peaked there. As it decelerates, let's say to 10%, the market tends to flatten out. But on the way up, the market does double-digit annualized returns. So when we see money supply growth roll over, historically the VIX rises, the volatility increases, and the S&P starts to flatten out. And I think that's what's going to happen. But again, if they pour all this money into the market, do more QE, repress the real yield, we will get a bubble, and that bubble will burst. And it burst in 29, and it burst in 99, early 2000, and it's going to be damaging.
Barry, given the valuations, are we not already in a bubble from your perspective?
Well, the bubble is like climbing the stairs, right? We're on the first landing. We've definitely gone up one rung of stairs. But to actually get to a bubble, we'd have to be looking at like 40 times CAPE trailing 10-year real operating earnings, or 40 times 128. And, I saw that Dalio did a piece recently. His bubble meter was at the 75% measure. Our measure is that we are at the 75% of a bubble being around 5,250. So I would agree with that we are climbing towards a bubble, but we haven't gone parabolic yet, and that could happen if they make a mistake and let the real yield stay repressed.
Barry, down in Washington, they're about to throw a few more logs onto the fire here with regards to economic stimulus, economic relief, whatever you want to call it here. There is some concern here that as much as that money might be needed for a lot of folks on the ground, there are larger concerns here about inflation and about the long-term implications of some of these programs here. How do you factor that into your outlook?
Well, just if you pull up a daily chart of the 10-year yield, it's been on a 0.90 R-squared trend for 30 straight years, down and curving slightly to flat. Okay, so we could easily go by 2022 perhaps to a 2.5 10-year. If you look at the TIPS yield, like I mentioned, it was as low as -1. The market PE was in the 30s. And this is on trailing earnings. It's probably going to go to about 0 to -0.25, and that would push downward pressure on the PE against upward earnings and keep the market from rising. So your question is, what about inflation? 10-year minus TIPS is break-evens. We've got break-even inflation, probably 2.25 plus or minus a quarter, stabilizing. The fiscal is excessive. It was a big political giveaway. It really wasn't a lot of money that's going to immediately go into the system. Okay, so a lot of it was long-tailed money, like pension fund bailouts. Yeah. And as a consequence, you really have to look at the part that's high velocity, the money that's going to go right into the system, like the stimulus check. And that's going to be here. That's going to have an effect. It's going to supercharge the economy into the next quarter.
Barry, with all the shout-outs for what you should be using on your Bloomberg terminal, we let Barry Bannister, Stifel Chief Equity Strategist, we thank you for the perspective. Yeah. All things bubbles today. Meanwhile, we're looking to remain at...
Caroline. It was very
I was
telling.
running them all.
Yeah, okay.
Yeah, exactly. Just simultaneously typing them all in. Sadly, we couldn't show it on the TV. Meanwhile, what we can show you on the telly right now, 16 seconds to go, and we're down on the S&P 500. Yeah, it looks like we're about a 5-point decline here on the S&P 500 as we wait to get the final sell-in here of these trades. But it looks like it's going to be definitely a down day for the Dow Jones Industrial Average. Down about 0.3%, 0.4% there. NASDAQ looks like it's going to squeak into the green here. We don't have it on the screen, I believe, or there it is. The Russell 2000 here. This is your big underperformer of the day. And this is significant, folks, because when we talk about that reflation trade and that reopening trade, a lot of that was reflected in Russell. A lot of this is a drag down today. I mean, all the sectors in the Russell are lower, but a big drag is coming from the energy space and in some of those financials.
And Romain, that really sets it up nicely as you take a look at the sector level. Some of the gainers, you mentioned, of course, big tech, and you smartly pointed out Apple and Facebook as some of the leaders today. So you certainly see media and technology, some of the big gainers say, sort of that defensive trade, if you will. You migrate downwards, and Romain, you nail it every time. So I'm just going to copy you here.
I do.
Energy lower, in part because you mentioned Russell is the big underperformer. So you've really energy and autos, the biggest losers today, though year to date, still some of the best performers.
Yeah, well, you take a look at some. Thank you. Well, you take a look at some of the big gainers today. I mean, Apple, first back-to-back gains we've had on Apple going back to early February. That's significant here. I mean, usually this is a stock that manages to put a lot of gains together. That has not been the case. It's pretty much been on a downtrend since that January 26th record high. Netflix up for a second day. Moderna getting a nice boost here on word that they actually gave their first doses in that vaccine trial for children under the age of 12. That could be big here if that trial actually works and it sort of results something positive there. Starbucks up here on the day. Flip up the board. You take a look at some of the decliners today. Ford. We didn't talk about Ford today. They took a big leg down here. They came out with some interesting commentary about that chip shortage. Apparently still not resolved here. That might have been part of the reason. There were some other catalysts there as well. Tesla. I don't know what's going on there, but maybe...
How much of this is day two, right, of VW, Romain? We talked about Volkswagen so much yesterday and battery. They're trying to take on Tesla by mid-decade.
Yeah, and Volkswagen got a huge pop earlier today. I mean, at one point they were up over in Germany, up 25%. I think they ended up closing out the day just up about 6.7% here on the day. Fuel Cell Carnival taking a leg down, Caroline.
Interesting that you bring in European stocks, because I think there was a little bit more risk aversion creeping into the market because of what's happening right here in Europe. I'm going to start, therefore, with what was sort of happening in the oil market. Go cross commodity for you, go cross asset on global macro movers, and WTI crude is where I zero in at. Down about 1%. Now, sure, we're up about 3% in the start of this year. Nevertheless, we're sort of maybe pulling back a little bit in oil because we're worried about the growth trajectory. Why? Because, Italy's back in lockdown. We're worried about the vaccine vaccine, particularly that of AstraZeneca, getting into people's arms as there's worried about a blood clot here. I think that did breathe some sort of risk aversion into the market. We saw the dollar basically close out flat because we had a mixed picture in terms of stocks. But we did see how perhaps some of those haven trades get a bid. The Swiss franc up 0.4%. Interestingly, we saw euro off by 0.2% as we're worried about where European growth goes from here. If we can't get the vaccine rollout coming thick and fast as we see in the United States, maybe therefore we have seen a mixed picture in terms of the bond market. Swiss bonds actually getting a little bit of a bid here. So I felt that there was caution in Europe that kind of spilled into US trading too, Taylor.
Bonds are trash, Caroline. Did you know that? We had two people on this program, Ray Dalio, Bill Gross, saying kind of hard to justify bonds at these levels, right? Some people are short treasuries, and you take a look, and well, not much going on within the bond market. I don't know if they're trash, Rain, but inflation is not trash. Inflation, we could see up to 3-4% this year, according to Bill Gross. That's part of the stickiness that we see within the bond market today. Of course, 20-year auction doing better than good. I want to